The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A jittery week for markets, wrapping up with a flailing rebound, and some of the biggest companies in the world getting ready to report earnings. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Emily Griffeo. We're kicking you off to the closing bell here in the U.S.
And let's talk about that flailing that we're seeing in the markets right now. The S&P 500 now unchanged on the day, giving back an earlier gain, trying to decide what to do in the last hour of trading. But you have a lot of pain coming through when it comes to big tech. The Nasdaq 100 down by more than 1%, a reversal in Intel versus the after-hours session last night, certainly weighing on that index. Then you have Brent, a little bit of relief when it comes to the energy markets, down about 4%. But take a look at the levels that we're talking about, just below $97 a barrel, causing a little bit of relief too when you take a look at the bond market, down about 2 basis points on your 10-year treasury yield. But Emily, once again, relatively lofty heights.
Yeah, when you look at the individual movers in the equity market, Apple is driving the S&P 500 higher. Not high enough to actually get into the green, at least right now, but it is up about 3.5%, a bright spot in that broadly lower tech sell-off that we are seeing. They have earnings next Thursday. Tesla really getting a hit after a double-digit loss just yesterday. Shareholders disappointed in the earnings. What does that say for the rest of the tech earnings to come? We'll have to see next week, Katie. Booz Allen Hamilton, though, this is a bright spot. All they did was reaffirm their revenue forecast, and they're up 12%. Sometimes all you have to do is reaffirm.
There you go. So some bright spots to be found if you look for it, but certainly it's been a bit of a punishing market. And that's where I want to start with Anne Miletti. She is head of equity investments over at Allspring Global Investments. And great to have you with us. We have a really interesting stat coming from Bloomberg Intelligence that if you think about the S&P 500 companies that have reported thus far, and it is early in the reporting season, 85% of them have beat their profit expectations, but still the median stock has been unable to outperform the benchmark on the day that they actually deliver results, or the day after, rather. And, you know, I wonder what you make of that stat and what it says about sentiment overall as we really head into the heart of earnings season.
Yeah, Katie, it's a great question and an interesting stat. But I think what's also really interesting is the amount that the companies are beating their expectations by and what earnings growth still looks like. And earnings growth appears to be really, really strong. It just feels like we have two worlds colliding. Really strong fundamentals for companies, good earnings growth, a pretty strong economy, yet fear that the spend in CapEx is too much. Not that AI is not real, but that the spend is too much, and the potential for rising rates along with higher oil prices. So it feels like investors are starting to wonder how long the success can stay around before it gets put in check by higher rates.
And let's focus on, you know, one of the reasons that you laid out. A lot to dig into there, especially when you think about what's going on with the cross-asset picture. But when it comes to the concerns about spend, I mean, how widespread are those concerns? Because, okay, there's the hyperscalers themselves that are spending all of this money, that have all these lofty CapEx ambitions. And then you think about sort of the daisy chain from there, where they're actually putting that money.
Yeah, I think it's a real concern. As we know, technology cycles tend to get cheaper over time with development. And so I think there's real fear that a lot of the cost is being done at a high price right now, or a lot of the innovation, a lot of the investments being done at a high price. And there's fear that it's going to continue to get cheaper, but the dollars we're spending now may never produce returns. And so that's kind of the interesting situation most companies are in, because you have to invest in AI and kind of the new world in order to stay relevant. I think it's really the big spenders that we see, primarily, what we see in the hyperscalers. Sorry, those are the companies that are really truly spending a lot and investing in other companies to spend a lot. And so I think there's a little bit more fear because the outliers are really controlling the destination. And there still is there still are a lot of companies underneath that are spending, but maybe at a more disciplined pace.
And what did you make of the market's reaction to the Alphabet earnings? The company comes out, they say they're going to be spending more on AI CapEx. The shareholders were not happy. Are we going to see that next week during next week's mega cap tech earnings?
I think investors, and when I talk to our portfolio managers, they're really looking at not just the CapEx spend and the increase, but how it's affecting the overall balance sheet. The important thing is, while earnings are going up, free cash flow in many of these companies are going down. And again, how long can that spread last or go on before investors really start to question the spend? So it's not surprising to me that we're finally at the point where investors are really questioning the sustainability of the spend and then the return of that spend, more importantly.
You mentioned industrials as being an opportunity here in the notes that you sent over. The sector is already up 18%. How much more leeway, growth do you see in the industrial sector?
I think there is a lot of potential for return. Again, the outliers have been driving the index, and below that, diversification really seems to be pretty much on sale. So while industrials are up 18%, it's lagging certainly the technology sector. And in the industrial sector sits at kind of an important crossroads where you have kind of reshoring or realignment of global supply chains, but also a lot of investment in the AI CapEx spend. And there's many companies benefiting from that. And I think mid-cap industrials in particular look even more attractive because some of the global disruption is not impacting those companies quite as much.
Well, Ann, you mentioned diversification on sale right now. I do want to talk a little bit about the broadening out that we've seen in these markets, because you mentioned mid caps, small caps also outperforming, broadly speaking, value also outperforming. And I just wonder, how sustainable some of that outperformance, some of that rally is when you think about what we're dealing with in the cross asset picture that you mentioned, higher energy prices, higher yields as a result.
Yeah, it is really something you have to pay attention to on a company by company basis. And now, is the time our managers are really leaning into that and digging into the fundamentals of each company. Because if the macro environment changes, and again, we don't really control what the Fed will do, but if that environment changes, what companies are set up well to continue to grow and expand and control their own destination without a cheaper or without even in the face of a higher rate environment. And so there's a lot of opportunity still below those mega outperformers, and that's what we're tending to pay attention to, especially in that small and mid cap space, and in certain other industries as well.
All right, Ann, really appreciate you stopping by. Have a great weekend when you get there. That is Ann Miletti. She is head of equity investments over at Allspring Global Investments. Now, coming up, a download on the most important factors fueling the data center build-out with an executive deeply embedded in that space. Former Intel data center executive Sandra Rivera, now chair of French deep tech company VSORA, she'll join us live. Plus, from the data center to the driver's seat, one of Tesla's earliest employees joins us to discuss the road ahead for the automaker after a rough week for the shares, and how his own company is powering battery products across AI, robotics, and more. And Mark Cuban-led investment fund taking a stake in MLB's athletics. We'll talk to the founder of that fund, Rashaun Williams, about the big bet on Las Vegas and what comes next for Major League Baseball. All that and more coming up. This is The Close on Bloomberg. President Donald Trump rebuilding his tariff framework with new levies on 60 of the world's economies. The move adding fuel to investors' worries around inflation and high energy prices. Joining us to discuss is Henrietta Treyz. She is managing partner and director of economic policy over at Veda Partners. So, Henrietta, you think about what we learned over the past few hours, the U.S. Going to impose tariffs between 10% to 12.5% on imports from around 60 economies. The cited reason is preventing, or their failure rather, to prevent forced labor in their supply chains. Just to start, give us some context. What do you make of this move? Because you take a look at markets and investors' minds are elsewhere right now.
Yeah, investors' minds are elsewhere because there's obviously a war going on. The war is expanding into a focus on Russia and Ukraine, the Red Sea, the Black Sea, Bab el-Mandeb. It's all over the place, and crude prices are spiking again, taking a little relief today. But it's an underlying reality that we're obviously going to be in this war for the foreseeable future. Lots of concern about what the Fed is going to do on interest rates. And the tariff stuff has been interesting all week. You know, I published a piece on Monday just reminding folks that this event was going to occur. So it was obviously well known. There was a question about whether or not tariffs might fully drop off, just to give the Republican conference some breathing room going into the election when voters' number one area of dissatisfaction is high prices, and tariffs are to blame for that in their opinion. So this combination is really just pouring more fuel on the fire, as makes sense. So investors have a lot to look at right now.
Well, you went exactly where I wanted to go, and that is what is the potential implication for the midterm elections? Quickly approaching now, we're at the end of July. We know that when we talk about these high energy costs, that's making its way into food prices, energy bills, the list goes on. And now you add tariffs on top of that, potentially saddling American importers with costs here. It seems like a tricky political sort of thread that is being threaded right now.
Man, let's put it this way. The president is not threading the needle. The American public doesn't like the tariffs. There's a new poll from Politico out today that I actually published on X earlier, and you can see the number one reason people think that gas prices and prices in general are higher is the Iran war. Second is the tariffs. And they blame both of those things squarely on President Trump. And if you look at the approval ratings of the president versus, say, the Republican Party or the Democratic Party, he's doing twice as badly as both of the parties as a whole. So voters are really pinning the blame directly on the president. These are executive actions. It's the executive branch's decision to go to war, the executive branch's decision to put these tariffs on. So voters are responding appropriately. They're seeing who's in charge here and who's making the call, and they're putting the blame squarely on President Trump. The struggle for Republicans is that Trump is also the most popular politician within the Republican Party. And so that leads you to a scenario where Democrats are favored in generic ballots. In the Emerson poll that came out today as well, it's D plus 11, which is even more dramatic than the wave we saw in 2018. So the president's going full steam ahead. He doesn't have to be on the ballot, but everybody else is.
Henrietta, how do you think all of that factors in with the threat of just inflation remaining higher, not just due to tariffs, but due to geopolitical volatility, due to the continued onset of the war in the Middle East? How does Trump kind of factor all of this in?
You know, these are fascinating data sets. I'm so glad you asked that question. A lot of companies are actually using the war, per the data that we've had in the last 5 months, to actually cover them as they pass through, at long last, some of the costs of tariffs. You can see it in sneaker prices continuing to rise, apparel continuing to rise. That's not stuff that flows directly through the strait. The stuff that we get through the strait are, you know, the different kinds of fertilizer, urea, crude, jet fuel, the helium, nitrogen, things like that that go into a semiconductor, packaging, obviously food products. But the pass-through that we're seeing from the start of this war going back to late February continues to suggest that the tariffs that have been so volatile for the last 18 months are now being even more directly passed on to U.S. consumers. So this is going to be inflationary. And I note a couple of things. Number one, a number of countries are tariffed at higher rates than they have been for the last 150 days. And the president's own tweets and suggestions today, whether it's 50% tariffs on Canada, another round of tariffs on the EU over their digital services taxes, and more besides, suggest that these tariffs are only going to rise. So for Federal Reserve Chairman Warsh, he's got to be aware that this is not the end of the story on tariffs. These low 10 to 12.5% rates that are in place today are only going to rise from here. Maybe it'll take until November 4th before he starts doing it, but inflation from tariffs is with us.
And I wonder, you know, when it comes to the inflationary backdrop, especially as it relates to tariffs, would you expect retaliation from some of the countries, the 60 economies or so, that these levies apply against? Or, you know, how is this being received by the rest of the world?
You know, they're not responding with reciprocal tariffs, but we don't have any trade deals. So the trade deals that the president has touted and suggested is finalized are not. So, for example, one I was just talking about with the client earlier this week, Japan promised to pay $550 billion in investments over, the course of the next decade or a couple of years to the United States. And what have they actually done? They've delivered a $1 billion sort of more superficial, let's join in this effort investment at the president's request. So the trade deals, the opportunity for retaliation is really just slow walking. So that's true for South Korea, Japan, the EU, the UK. We are in violation of all those trade deals. If you want to get down to the nitty gritty, we're in violation of our trade deal with Vietnam, Indonesia, Malaysia. So a lot of those have just been ripped up. I don't know how other nations would retaliate given the trade agreements aren't in force and the tariffs keep changing.
All right, Henrietta, great to get some time with you. Appreciate it. That is Henrietta Treyz. She is managing partner and director of economic policy over at Veda Partner. Now, coming up, shares of Intel falling. We're going to break down the chipmaker's move and get a read on the larger semi space with Matt Bryson of Wedbush Securities next. This is The Close on Bloomberg. It's time now for our top calls. Look at some of the big movers on the back of analyst recommendations. And first up is PayPal, with Truist Securities upgrading the fintech stock to hold from sell. The firm citing the potential takeover bid from Stripe for the upgrade of PayPal, raising its price target on the stock to $57 from $44. Shares slightly higher on the day. Next in line, Mizuho is taking a slice out of the Cheesecake Factory today. You heard that right, downgrading the stock to neutral from outperform. The firm saying that the restaurant chain already trades at a premium to its competitors, but still it raised its price target on the stock to $85 from $75. Shares slightly higher. And finally, we have BMO upgrading Dover to outperform from market perform after the company's 8% drop on Thursday. Analysts saying that the move lower appears overdone, and emerging applications across data center and space have us intrigued for the bridge into 2027. Firm cutting its price target to $240 from $255, still well above where the stock is currently trading and rising a little bit today. And those are some of our top calls. Now let's stick with data centers because shares of Intel dropping today. This comes after the chipmaker beat second quarter estimates for its data center and AI business segment, posting 59% year-over-year growth. Let's bring in Matt Bryson. He is managing director of equity research over at Wedbush Securities. Matt, great to have you with us because I want you to explain the turnaround that we've seen in Intel, because a little over 24 hours ago, we were breaking the numbers on air here on The Close. You saw the stock absolutely soar after hours. I look at it today, 24 hours later, down about 8%. What's going on?
Yeah, so my preview into Intel's call was, it's not so much about Intel, it's about sentiment around AI spend, and that's exactly what we're seeing. So Intel gave us a really strong report. They said good things about where they are technology-wise, right? 18A is on track, 14A is getting pulled forward, so they're fixing some of the problems. Gross margins were better. Maybe they could have given us a little bit better gross margin guide, but I think that they're just setting up numbers to beat again. The issue with Intel is people are worried that the spend we're seeing in data centers right now is unsustainable, just because there's not enough free cash flow at the hyperscalers to justify them continuing to raise capex forever.
And I hear what you're saying, that, this is more about sentiment on the space overall, on spend overall, than it is about Intel. But if you were looking to get concerned, a few folks have pointed to the fact that they have yet to have a signed external foundry customer. Do you think those fears are overblown, or how are you sort of factoring that in?
So my struggle with Intel is that you're looking at a company that running their fabs full. That's a good thing for margins. They're raising pricing. That's a good thing for margins. And yet Intel is 2,000 plus basis points below where you want their gross margins to be. Their competitors like AMD don't have that problem. TSM doesn't have that problem. And so the kind of how do they bridge that gap question is what keeps me awake at night. And in this type of environment, with Intel more expensive than its peers, there's not a whole lot of valuation support when things go bad. And so that's what I think is weighing on Intel versus anything that they're doing wrong per se.
Matt, what do these results tell you about what to expect for big tech earnings next week and other chip earnings next week?
Look, Intel told you that compute's tight. I just came back from AMD's AI event. That's what everyone was saying. Compute's tight, memory's tight. There's a ton of opportunity to build out AI capacity because there's a ton of demand for it. And so I think at least in the semiconductor space, you're going to consistently be seeing these companies beat and raise. Heck, we had Supermicro earlier this week talking about 60 billion in new orders during the quarter.
Right.
I think that's what we're going to hear. Is just people are going to be concerned around the sustainability of that. The question is, does it matter?
Do you think that just given how much Intel has already run up this year, over 160%, it's more susceptible to this post-earnings volatility than, say, an NVIDIA?
Yeah, I mean, NVIDIA is trading at, I believe it's around 20 times my next year numbers. So you just have some valuation support that you don't have with Intel. And the expectations that NVIDIA numbers keep on going higher. So not only do you have that valuation support, but arguably that multiple is even cheaper. So yeah, if I can look at NVIDIA trade that's growing at 70-80% a year and is trading at 20 times, even if things get more difficult, it's just so much easier to justify the valuation.
All right, Matt, got to leave it there. Really appreciate the context. That is Matt Bryson. He is Managing Director of Equity Research over at Wedbush Securities, walking through those Intel results and the reaction that we're seeing in shares today, down about 8%. But of course, we've seen shares rocket by more than 300% over the past year or so. So, you know, it's not too bad for Intel just yet. But coming up, we're going to continue the conversation on data centers. A big part of what's fueling Intel's turnaround overall. We're going to count the catalysts behind the build-out with Sandra Rivera. She is a former executive VP of Intel's data center and AI group. That conversation coming up next. This is The Close on Bloomberg. Just about 3:30 p.m. in New York. This is the countdown to the close. I'm Katie Greifeld.
And I'm Emily Griffeo.
And we're keeping an eye, of course, on these equity markets, where a lot of the fear in the market right now is related to AI data centers and whether or not the spend that we're seeing is going to be justified by returns. But you're seeing some jitters when it comes to the corporate bond market as well.
I mean, look, these companies are trying to raise a ton of money. They have to basically raise this to build data centers, to buy chips. But our reporting just from today, BlackRock has seen weak demand for its $12.3 billion investment-grade bond sale to fund a data center project with Meta. I mean, they're getting the deal done, but again, maybe a signal that these investment-grade bond investors are just getting a little tired.
Absolutely. And, you know, you could draw a parallel here to what we saw with Amazon's debt offering a couple of weeks ago. Oversubscribed, as we were chatting about in the commercial break, but only 1.6 times, which is not exactly the levels that we've been getting used to for some of these deals. But let's keep the conversation going on AI and the data center build out with Sandra Rivera. She is former executive vice president of the data center and AI group over at Intel, now chair of French deep tech company VSORA, and a board member at data center infrastructure company Equinix. So clearly, Sandra, you are the correct person to be talking to on a day like today. And first of all, I'd love to hear your thoughts just on the landscape right now, because it seems like, you know, you talk to most people on the street and the consensus is that AI is real, but there is a lot of concern, a lot of agita over the numbers that are being spent to sort of fund this AI data center build out, whether or not the dollars that are being put in now are going to see the return as just things and the technology overall gets cheaper. And I wonder what you make of the entire environment.
Well, we certainly know that data center infrastructure is critical to our economic prosperity, to our national security, and to our overall technology leadership role in the world. So despite the fact that perhaps the narrative may be a little on the negative side right now, data centers are essential for everything that we do every single day, whether it's banking online, whether it's streaming a movie, whether it's a telehealth appointment with your doctor. Data center infrastructure is essential. But we are seeing that enterprises are moving from early days of experimentation and discovery and adoption to now scale deployments, and they want to see an ROI for that deployment. And I think that you've had guests on just today talking about how the CEOs and CIOs and CFOs want to see not just perhaps the low-hanging fruit of some incremental efficiency gains, but real workflow automation and real transformation for the overall business that leads to better outcomes both for customers as well as their own financial results.
Absolutely. It does feel like there's been a shift here. Now it's more of a show me story versus just how much are you spending, how much are you putting up to some of these ambitions. But Sandra, I'd also love to get your thoughts on some of the concerns that, we could be witnessing a massive overbuild when it comes to data centers. You think of just the physical footprint that is being built right now. There is the idea that not only does technology get cheaper, but it gets smaller as well.
Yeah, well, that is certainly true. There is a massive amount of investment going on, extraordinary amounts of capital going into data center infrastructure. But from everything that we can see in the data and in customer demand, the demand is there. I think that what generally happens with these real structural changes in transformational technologies is that they tend to be overhyped in the short term, but perhaps underhyped in the long term. The changes are structural. They come from that transformation that I was referring to earlier in terms of business workflow and how the work happens and how products or services are delivered. And we really don't see any waning demand for that, even as we see actually the move to agentic AI driving more complexity, more reasoning, more planning required, and frankly, more heterogeneous architectures in terms of what those customers need to deliver that product or service. So perhaps there is some nervousness, some skittishness about the amount of capital going into all of the infrastructure build-outs. But I think generally the providers of those products and services worry more about underbuilding and not having enough capacity than perhaps overbuilding for the short term, where they absolutely believe that this is a structural change in the long term.
And Sandra, tell us a little bit about VSORA. What are the kind of chips that you're working on, and how are they different than something that we could see out of an Intel or an NVIDIA?
Well, so I talked a bit about heterogeneous architectures, and one of the things that we know is that all of the applications and the workloads are very broad and diverse. So there really isn't a one-size-fits-all when it comes to compute infrastructure, and the story has been largely about the demand for GPUs, and now you see with Intel and other CPU providers, general purpose processing, CPU providers, that in fact what used to be a ratio of maybe 1 CPU to 8 GPUs for lots of parallel processing when you're training those big models has now moved to 4-to-1 or 2-to-1, or in some cases 1-to-1 GPU to CPU for the processing of agentic AI. But the other thing that we know, and this is where companies like VSORA come in, is that the actual chips that are general purpose processing like GPUs and CPUs are not as well suited for the requirements for deep inference and large scale inference deployments, where low latency, high levels of determinism, low power, low cost is very critical. And that's why you see so much innovation in so many startups like VSORA that are focused on AI inference chips exclusively, really designed for the moment.
Interesting. So would you be maybe looking to partner with Intel, or do you see those big semiconductor companies as competitors?
We see them absolutely as complementary. There is a not one size fits all, but clearly there is a very complex AI data pipeline that is about compute, where chips like Intel's chips and VSORA's chips fit in, but also where memory management and networking innovations and storage capabilities are required. And again, where you see so much innovation on companies building specific semiconductor chips to address some of those problems and some of those opportunities. So heterogeneous architectures will rule. There's plenty of opportunity for everyone, and a lot of it will be these complementary capabilities to build out your overall AI and data infrastructure capability.
Well, Sandra, I would love to hear your thoughts on Intel, this current generation of Intel. You worked there in various leadership roles from 2000 to 2023, so quite a track record there at the company. We know that they have been sort of engineering this turnaround, and you've seen that reflected in the shares, the traction that they've gained, but still at a bit of a crossroads when it comes to, their ambitions to really fashion themselves into a foundry at the same time that they're seeing a lot of traction when it comes to data centers.
Well, I think to your point, they have two very highly connected but distinct businesses. One is their CPU franchise, both on the client side as well as the server and data center infrastructure side, which is, as you heard from Lip-Bu and Dave yesterday, the demand is outpacing supply, so that's very much the good news story. I think on the foundry side, these are very long-term bets. When you're in the semiconductor industry, you make long-term investments for future returns, and that business is absolutely improving. They're demonstrating that quarter on quarter, but it is a long-term investment with returns that are typically out in the future for several years. So I think what we heard was a positive story that everything is trending in the right direction, up and to the right, but it just takes time. But, I think that we should all be cheering for Intel. I will always be cheering for Intel because having that capability of leading process technology here in the U.S., particularly when we think about national security and data sovereignty, these are important capabilities for us to have here domestically.
Our thanks to Sandra Rivera, former executive vice president of Intel's data center and AI group, now chair of French deep tech company VSORA. This is Bloomberg. And our stock of the hour, American Express shares sinking after reporting second quarter revenue and net card fees that were below expectations. The stock is now on pace for its worst day since February. Joining us live to break it down is Bloomberg TV markets correspondent Nora Melinda. Good to see you, Nora. So tell us what's going on with Amex.
Well, the bar was high coming into this report. This is a company that trades at a premium, almost 70% premium to most of its peers. So if you think about a stock that's trading that high of a premium, you're going to expect the bar to be quite high going into the report. Now, digging into what the analysts were actually thinking, though, it was a pretty solid quarter. I mean, we did see an EPS beat. We saw credit quality that was deemed excellent. And then essentially we also saw that customer spending did grow actually at the fastest pace in 3 years. Oh. But what's underlying is this idea about fees and interest income. Now, that's the moneymaker for Amex more broadly. The concern is about the fee revenue. Essentially, it's more about the fee revenue than it is actually the temporary hike that we did see, particularly when it comes to expenses. So it's a bit of this battle here between the fee revenue and the expenses that we did see essentially investors really expecting an acceleration, and they saw deceleration for this quarter.
Well, give us some more color on, what sort of expenses that we're talking about here, because you think about the surge that we did see, a jump of about 12%, right. Certainly turning eyeballs today. Is that what I want to say?
I like it.
All right.
So we saw them spending on marketing. We saw them spending on benefits for customers. Also, there was that platinum card refresh. We saw the platinum card that roll out in September. Card. Yeah, the loud one, the one that clanks.
Clank.
Gotta have one, right? I don't, but many do. So people were expecting a refresh on that card. And then lastly, they were trying to attract millennials and Gen Z. And to attract millennials and Gen Z, it takes a lot of money. And that's what we're seeing happening here with this company. The concern is really about whether or not all the spending that they are doing on attracting these demographics is actually worth the money.
Absolutely. Well, you take a look at American Express shares, certainly a little bit depressed today. Really appreciate the reporting. That is Bloomberg TV markets correspondent Nora Melinda. Meanwhile, we do want to bring you some breaking news. This coming courtesy of the New York Times that Paramount has agreed to delay its Warner Brothers merger until June of 2027. So, of course, this comes after we saw that $180 $11 billion merger, that agreement to freeze it. And Emily, you can see that the share is reacting right now.
Yeah, it's interesting. Warner Brothers shareholders, I guess, okay with the deal potentially being on pause for a little bit longer. Paramount getting hit more, down about 1.5%. As we know, this is one of the largest M&A deals ever, particularly in media, one that would remake Hollywood. There's a lot of debt involved as well, so a lot of eyeballs on this, but it seems like we'll have to wait, Katie.
Yeah, and certainly it was quite a process to even get to this point where we had a deal. We'll continue to follow this story, but coming up next, we're going to take you to the closing bells with Jurrien of Fidelity. This is The Close on Bloomberg. Just about 10 minutes to go until the closing bells on this Friday afternoon. I'm Katie Greifeld.
And I'm Emily Griffeo. In for Romaine Bostic. He's on assignment right now.
He's on assignment or he's on vacation. No one truly knows, but he's missing a sell-off when it comes to the S&P 500. I say sell-off. The number isn't huge, but it looks like, Emily, we're going to close another week lower on the big benchmark, the second consecutive week of losses.
Yeah, and you can see the tech shares getting hit even more. Apple's a bright spot, but the NASDAQ 100 lower. Brent getting hit. Yields, they were on a ride this week, Katie. That 5-year is what I keep paying attention to.
The belly.
Not the 5-year. Actually, the 30-year, excuse me, above 5%. It's a Friday.
Yeah.
Numbers are difficult, but it'll be interesting just to see whether rates continue to stay elevated or we see today's trade.
Yeah, and at what point maybe some of that yield indigestion comes into the equity market, which is much more focused on AI spend right now. But let's unpack all the different cross currents now with Jurrien. He is Director of Global Macro for Fidelity. Pleased to say that he joins us now. And Jurrien, cross currents. I mean, there is so much to talk about here, but let's talk about why you're seeing the NASDAQ 100 lead losses today, and that is that consternation overspending that we're seeing when it comes to the AI build-out, when it comes to the data center build-out, the concern that, you know, we're not going to see the payoff that would justify some of the numbers that are being put up. I wonder what you make of it all.
Yeah, so good afternoon, happy Friday. Certainly the demand for capital for the AI build-out is, you know, insatiable, right? And so, you know, in the U.S., we have the compute. We don't have the power. In China, they have the power, but they're behind on the compute, although they are catching up. And so the market is going through some indigestion, asking, you know, how much is too much? And we're seeing it in some of the financial ratios. You know, the Mag 7, which of course were the star of the show for 10 years plus, have been underperforming since last October. And because the CapEx burden is so large now, these companies are buying back fewer shares. Their payout ratio is down to 37%. So, you know, this is a big move. And of course, it's a generational, perhaps life-changing technology. But that doesn't mean that it doesn't come with a few lumps. And, you know, I've always said over the past couple of years that for me, the two tail risks are concentration risk, because the top 10 stocks are 40% of the market, the top 50 are over 60%, and term premium risk. And certainly we're seeing that again this week, where when the safe asset treasuries are competitively priced against risky asset, meaning they have the same yield or the same PE, if you want to consider it that way, then when rates move up, the equity market needs to pay attention. And so both of those risks are kind of, you know, on the forefront this week, although I have to say, you know, overall, the S&P hasn't made a new high since June 2nd, but it's only down about 1% or so, or 2%. The AI space is down 15, 20%, and the non-AI space is up about 5%. So it is a rotation, and so far, it's manageable, I think.
Yeah, and I mean, it's a good point. You think about the fact that, okay, we haven't seen a new high in a while, but we're still pretty dang close in the grand scheme of things. Certainly speaks to the resiliency of the rest of the market. But I do want to talk more about that cross-asset picture, because you mentioned the idea rates going higher, yields at these lofty levels. It's something that the equity market is going to have to contend with. And I wonder, you see a 10-year Treasury yield at about 4.7%. give or take right now. Is that a level that stock traders need to pay attention to, or what sort of range are you thinking about?
So I've been saying for a while that basically nothing good happens above 4.5%. And so for me, 4.5 to 5 is sort of the yellow zone, and 5% and above is the red zone. And we've seen that, of course, a few times. 2022, of course, was all about rate resets, and that really took the PE ratio down, right? And when we think about market impact from rates, price is only the residual or the intersection between earnings and valuation. So there's a clear inverse relationship between higher yields and PE ratios when yields are at competitive levels, as they are today. And by my sort of back of the envelope math, if yields go to 5%, the PE should go to about 18 or 19, and it's currently about 22. And normally that would be, a 10-15% decline, except that earnings are growing over 20%. And so therefore price might just be sort of stuck in the middle, as it has been for almost 2 months now.
What does that mean then for which part of the equity market is going to lead the gains for the rest of the year?
So the good news is that we're fishing from a pretty big pond now, right? So again, for 10 years, from 2024 until about a year and a half ago, if you were not in the Mag 7, you were really missing out, right? If you diversified into international markets or value or down cap, there was just not a lot of beta to be had, and certainly no alpha. That's all changed over the last couple of years, and other regions in the world are very competitive in terms of the growth of how much of their earnings they're paying out as dividends or buybacks, and as well as the payout ratio. And for instance, I can go to the most boring sector I can think of, which are European banks, and they have outperformed the S&P just as much as the AI stocks have. And they have a yield of 7%, and they pay out 88% of their earnings. And that's about as far to the opposite of the AI space you can get. But there is alpha there, and right now, 71% of stocks in the S&P are above their 200-day moving average. The PE on the S&P equal weighted index is only about 17, 18. So the market looks pretty good, and there is a lot of there's a lot of breadth today that we did not have until a few years ago. So it is good news for an active investor or an investor who wants to paint the world with a broad brush.
Yeah, certainly a lot of places to pick your spots as we think about the different pockets of outperformance. Jurrien, unfortunately, we have to leave it there. Never enough time. Have a great weekend when you get there. That is Jurrien Timmer. He is Director of Global Macro for Fidelity. Meanwhile, Emily, you take a look at markets right now. The S&P 500, it is red. The color is red, but we certainly have more gainers than losers.
Yeah, Apple leading the way in terms of how many points it's contributing to the index. Google as well. Apple at least being put up for the test next week when it reports earnings. It's going to be a big week next week.
Yeah, I am looking forward to watching fondly from afar. All of those big tech earnings coming next week after certainly a heavy calendar this week as well. Meanwhile, we are getting closer and closer to the closing bell. Another down week for the S&P 500. We'll walk you through all of the action with our global simulcast. It starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld alongside Emily Griffeo, filling in for Romaine Bosick. And here to help take us through the closing bell, it's a global simulcast. We're joined now by Carol Masser and Tim Stanovic. We bring together all of our various audiences to talk about, boy, what a flip-flop that we saw in Intel, really weighing down the rest of the market, Carol.
Yeah, absolutely. Although here we have a market that is kind of overall little change. We are seeing certainly some pressure on the NASDAQ 100. But you go inside the S&P 500, guys, and you've got 358 names actually higher for this session, despite the index being essentially unchanged.
Okay, index essentially unchanged. What's not unchanged today is oil. Even though Brent is up about 30% just this month, we're actually seeing it down a little bit today, $97 a barrel, so under $100 a barrel, which, Emily, is a nice, I don't know, a nice sort of benchmark to be below,
Let's go buy some barrels.
Yeah, I don't know.
Yeah, right.
Keep them in the backyard in New Jersey,
Double
right?
digits, not
WTI.
Was that in New Jersey?
Down
Yes.
just about
there, which is
2.7% to just below $90 a barrel.
Tim is determined to keep talking through all of our chatter.
About
I couldn't hear you. Were you guys saying something? I couldn't hear
No,
it.
nothing important.
Well, Tim was also mentioning the S&P 500 ending the day lower. If you look at how it ended on the week, this is the second week in a row that index is closing in the red. That's the first time that we've seen 2 weeks in a row of losses for the S&P 500 since March.
Yeah, and we were just talking with Jurrien and Timmer over at Fidelity, making the point we haven't seen a new high on the S&P 500 since about June 2nd, early June. But we're still pretty close to those levels, which really speaks to the resiliency of the market outside of big tech. But take a look at the S&P 500. It managed to actually get into the green, but barely. I mean, we're pretty much talking unchanged on the S&P. A different story when you take a look at the NASDAQ. Certainly a heavy day for big tech. The Dow Jones Industrial Average, I'll mention it one more time. It's finished the day higher by about 0.5%. It's price weighted, though. What can it tell you? I don't know, but the number is green. Small caps, though, Carol, falling a little bit on this Friday.
Maybe you should name the upcoming baby Dow.
Can you imagine? I don't know if that's like a beautiful baby girl name, but I'll think about it.
All right. If not, there's always the S&P 500, which, by the way, we had 364 names actually gaining ground today. 139, Katie, to the downside.
And let's take a look at the circle one last time for me. And boy, what a pretty picture. It's a really interesting picture because you have 10 sectors finishing the day in the green, led by none other than real estate, higher by 2.4% as a sector. Materials also higher, consumer staples as well. Your lone red spot is an important one. It's information technology, down about 0.9%. Really explains why, when you take a look at the index math, how these sectors are weighted, why the S&P 500 finished just about flat, even though you have all that green on the screen.
Katie, if you had to pick a sector and name the baby after a sector, which one would it be?
Utilities.
Well done, well
Wow,
done.
you said that so quickly. That's really weird.
She's apparently been thinking about this.
I think about it deeply.
All right, let's go to some of the individual gainers, if we may. SLB, top gainer in the S&P 500, up about 11% here, folks. Oilfield Services and Equipment Company, you know it well. Formerly Schlumberger, doesn't go by that anymore. SLB also could be a fun name, I'm just saying, Katie.
There you go.
Company reported second quarter adjusted earnings per share that beat the average analyst estimate, revenue increasing in all regions outside of the Middle East, and data center revenue. Apparently the company has been shifting to data centers, an emerging source of revenue for the company. Milius Research out. They've got a buy price target of 68. Noting that revenue, EPS, and EBITDA beat as broad-based international growth was able to offset the declines in the Middle East from the war. So that was an outperformer. Let's go to RingCentral. That one also rallying up as much as just missing the 30% gain mark intraday, but still up about 25% here at the close. Heavy volume. The software company reported second quarter results that beat expectations. They also raised their full year forecast for adjusted earnings. It is up 70% year to date, 12% of the float is short. And then one more for you, T-Mobile. This one rallying about 5.6% here. Top gainer in the NASDAQ 100, rallying even after the company reported revenue that missed analyst estimates amid modest gains in subscribers. They did disappoint Wall Street's high expectations. We saw that kind of in early trading playing out, but rallying here in the regular session. KeyBank Capital Markets out saying T-Mobile's service revenue growth was a mixed bag, and management's 2026 service revenue guidance remains at $77 billion. Another analyst, benchmark analyst, kind of saying that the sell-off earlier unwarranted, as the stock was already trading at a significantly discounted valuation. It was down, I think, pre-market, but again, rallying in the regular session.
Okay.
Over to you, bud.
All right, I got a lot of news here. Just starting with something that recently crossed. Paramount Skydance shares down on the day by 3.3%. The New York Times reporting just a little bit ago that Paramount and Warner merger is paused until a court rules or June of 2027. You can see right there toward the end of the trading session, shares were higher for much of the day and then took a dive after this report. Colorado Attorney General Phil Weiser saying a stipulation filed in federal court stops Paramount and Warner Brothers from merging until the court rules or June 1st, 2027, whichever comes first. Once again, Paramount Skydance shares, P-Sky down by 3.3%. Warner Brothers Discovery shares fell too by just about 0.7%. Also, shares of Uber declined today. This after the Financial Times reported that Waymo is exploring options to exit its Uber partnership, down 4.3%. That fell after 3 o'clock today, Wall Street time. Waymo has held internal talks about ending its current deal with Uber. Waymo has already notified Uber that it plans to enter these markets independently in January 2028 when their contract allows, the ride-hailing group said in a statement. Waymo has not ruled out a complete split, according to the people cited by the Financial Times. And finally, this was the worst performer in the S&P 500 today. It's down 9.3% at the end of the day. C.H. Robinson Worldwide, freight broker, and other freight brokers fell today. This after a jury ruled against C.H. Robinson Worldwide and 2 other defendants in a case involving a trucking accident. It boosts concerns about new sources of liability for the industry. Once again, C.H. Robinson Worldwide down about 9.3% today.
All right, let's take a quick look at the bond market, what it did on this Friday. A little bit of relief since, we did see energy prices come down a little bit, but similar to what we're seeing when it comes to Brent, we're still at pretty lofty levels across the curve here. You can see that 30-year yield well above 5%. So too is the 20-year yield. The 10-year yield trading a couple basis points below 470, and the 2-year Treasury yield certainly higher as well. But overall, a little bit of relief, probably a good thing for a lot of folks to see a quiet bond market today.
Yeah, not too shabby, right? It hasn't been that quiet for SpaceX. I feel like investors have been kind of heading for the exit door to some extent. The stock closing at $115 a share. There's some chatter on the street. Morgan Stanley, in particular, analysts over there, they say the sell-off in SpaceX shares has driven the stock near a level that would imply investors are assigning no value to its AI business in particular. To be fair, Adam Jonas writing in a note to clients today, we believe the current disconnect between increasingly bearish investor sentiment and largely unchanged fundamentals creates an attractive entry point in SpaceX.
Okay.
And says if it hit $100 per share, so if it went down even further, that's when a lockup on the first batch of shares unlocks, I guess, next month. If it hits that, basically, if insiders can sell, he says at that level, investors are pricing in zero or even negative value from its AI segment.
Okay, then what happens today?
Which is the value, right?
What happens today with the launch?
I don't know. Oh, yeah,
the Starship is launching today, which gets me interested in, this was supposed to happen yesterday. It was delayed as a result of weather, which happens when it comes to rocketry. But Katie, what happens, this is the first time that this has been launched when SpaceX has been a public company. So if it happens tonight at 6:45, I guess watch after hours and maybe watch what happens on Monday.
Right.
When I know, Katie, you will not be here.
I will not be here, but I will mention, hopefully the share performance has no bearing on the launch of their rockets. But to your point, Tim, it's going to be interesting to see if sort of shares react at all to the success or otherwise of the launch, because it's certainly not trading like a rocket company necessarily. It's sort of being valued on the ambitions of Elon Musk and that orbital data center.
It's almost like it's trading like Tesla traded for years, not as a car company.
It's true. That could be the parallel that
I just want to know, Katie, once you have your baby and basketball season kicks off, are you going to be watching LeBron?
I might be. I mean, apparently he's going to be playing for Phillies. That was the surprise headline today, that LeBron James is signing with the Philadelphia 76ers for his 24th NBA season. That ends an 8-year run with the LA Lakers. I don't know that much about basketball, but certainly I heard some ripples around the newsroom.
If he plays for the Philadelphia Semiconductors, might you watch?
That would be so fun.
Absolutely.
And we're no longer going to see that father-son duo in the NBA. That was the first time we had seen that in league history. So there's a little.
Will he still be playing when our kids have kids? That's the question.
Vibe.
We are going to see, though, a mother. I can't say. Can I say it?
You can. Yeah, go for it.
A mother-daughter duo?
Oh, yeah. We won't be playing basketball. We'll be doing something. This is my last day on the program, so my last simulcast for a while, if the audience hasn't quite picked that up yet.
Wait, you're pregnant? No, just kidding.
Surprise.
Hey, we're going to miss you a lot. We hope you will be emailing in between feedings and naps and all that stuff. No, we hope you ignore us completely. Enjoy, and we're going to miss you, and good luck and congratulations.
Congratulations, Katie and Joe. We are
Congrats,
excited to
Katie.
meet this baby.
Me too.
Yeah, and I think,
Pretty soon, God willing.
Call her Socks.
Yeah.
Little nickname.
We got a few good ones out of this 10 minutes that we spent together.
We're going to miss you. All right, be well, kiddo. All right, take care. That's a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Emily and Katie and baby in the tummy. All right, they're going to continue on the close on TV, and Tim and I back here on Bloomberg Business Week Daily on radio. Folks, we'll see you, some of us, not Katie, same time, same place on Monday.
And coming up, one of Tesla's earliest employees recaps the company's rough week and what's next for the battery industry that he helped to shape. That conversation up next. This is The Close.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld. Let's take a look at where markets close out on the day. On this Friday, the S&P 500 managed to go green, but just slightly, not enough to come close to erasing its weekly losses. A second straight week of declines for the S&P 500, really led by what we're seeing in tech, as evidenced by the Nasdaq 100 finishing this Friday lower by about 1.2%. We saw a big turnaround in Intel, sort of leading the charge lower here. Meanwhile, a little bit of relief when it comes to the energy market. Brent down about 2.7%, trading at about $98 a barrel, though certainly higher than where we've seen it over the past few weeks. And 10-year Treasury yields a little bit lower on the day, but still, again, elevated levels relative to recent history. Meanwhile, we go back to the equity space, highlighting some of the biggest individual movers on the day. Uber, some late-breaking news coming from the Financial Times that Waymo apparently exploring options to exit its partnership with Uber, sending Uber shares lower by about 4.3%. Also, some late-breaking news coming from the New York Times reporting that Paramount and Warner Brothers Discovery are pausing their deal until a trial or outcome, or until June 2027 or so. So a lot in the air there, and you can see that Paramount shares finishing the day about 3.3% lower. Meanwhile, let's also talk about Tesla, because it was one of the biggest movers on the week, down sharply on investor anxiety around AI spending and a drop in profits. Now, one of the bright spots in that report was energy storage, where Tesla achieved record deployments for the Europe, Middle East, and Africa region. Joining us live is Berdichevsky. He is CEO and co-founder of Sila Nanotechnologies, also one of Tesla's earliest employees. So, Gene, great to have you with us. And what you do over at your company, what you're doing with batteries, it's different, of course, from Tesla's energy storage business. So let's start a little bit with what you do. Describe what you're cooking up over at Sila, and how it sort of fits into the overall picture of batteries right now.
Yeah, so at Sila, we work on next generation chemistry. We make the next generation anode for the lithium-ion battery, which is a really key component that allows you to get more energy density, much higher power, faster recharge, and ultimately lower cost for battery technology everywhere. And that applies across electric vehicles, consumer devices, drone applications, even satellites. So we're really redefining the new chemistry that's going to change how all of these devices operate in the next 5 to 10 years.
And talk to us about, what your supply chain looks like, because across industries that's become an increasingly urgent conversation really over the past 5-6 years or so, and certainly amplified by what we're seeing geopolitically. What does the situation look like from where you stand when you think about some of your technologies?
So for anodes for lithium-ion batteries, it's got one of the biggest concentrations of production in China, about over 90%, and this is a problem for the whole industry. And by replacing that graphite anode that's there today with a silicon-based anode that we've invented, we're able to separate that supply chain. We're able to produce our technology here in the U.S. We just started up our Gigafactory in Central Washington, in Moses Lake, Washington. So we're producing in the U.S. Most of our supply chain comes from the U.S., and we're able to help companies decouple their supply chain, or at least reduce that risk. And so you're right, it's become really a fever pitch moment for some companies. It's really existential. If China were to cut off supply of graphite anodes the same as they have done in the past with rare earth magnets, you would have massive consequences to the U.S. economy. By our own estimates, some maybe 250,000 folks could be out of work downstream of that. And so Sila is able to help offset that and change that.
Yeah, I was going to ask, I mean, how big of a risk is that out there? The idea that China could basically just really restrict access, as we've seen them go through. You make the good point about rare earths.
It's a real risk. In October of last year, the laws were passed in China that allows them to exercise these export controls, not just on graphite anodes, but also on all the manufacturing equipment for graphite anodes. And they have such a lead in the industry that it would be very, very hard to replicate that industry here in the U.S. quickly. So the right way for the U.S. to go about this is really to invent the new thing, as we've done. We've invented the modern silicon anode. You can see the factory that we've completed. That's really just phase one of what will be ultimately tens and hopefully over 100 gigawatt hours of production capacity in the coming years. And then not only to invent that technology here, but the blueprint for U.S. innovation has to be to manufacture it here, just the same as Tesla has done, from inventing the modern EV, but also now making the most American-made cars in the U.S.
And I do want to get your thoughts on Tesla's journey. As I mentioned, you were one of the earliest employees over at Tesla. You left over a decade ago, but even still, curious to hear your perspective on where the company is in their own story, because they are a traditional car company. They're dealing with what you could say are traditional car company issues here when you think about, the demand for EV and, how they're going about pricing them. But then you think about all the ambitions that they have when it comes to AI, physical AI, and at the same time, they do have a bright spot when it comes to their energy storage business as well. Right. And I wonder, how you've been watching this sort of evolution of Tesla take place.
I think they're really not a traditional car company at all. Today the story really is about AI, and obviously the narrative today is how do we get enough data centers built and enough stationary power to data centers in order for AI to have a positive impact on our economy. Fast forward a year from now, I think the conversation is going to be, for AI to really have a great impact on society, you have to embody it in things out in the real world. We're talking about autonomous driving vehicles, right? Robotaxis, cybercabs. You're talking about robotics. How do you increase productivity without needing more people? And so I think Tesla's really a physical AI company today. Everything they make is going to be kind of the next bottleneck once we get enough power to the data centers that we need, and AI starts to want to have an impact in the physical world. And by the way, the company's also obviously helping those data centers get power through the Tesla energy business, which is booming today. So I think it's short-sighted to say, a bad quarter, a bad earnings. The key is, are they building the physical AI layer that's going to be needed? And I think they're one of the leading companies in doing that. Mm-hmm.
And before I let you go, Jean, I do want to talk a little bit more about Sila, because you recently announced a $300 million raise here. And how do you plan to use that money? When you think about $300 million, where are you going to be putting that and investing that?
It's really on expansion at this point. So we just earlier this year brought online the first couple gigawatt hours of production of our technology. And so the next step was for us to move to tens of gigawatt hours. The U.S. this year will buy about 250 gigawatt hours worth of batteries. And ultimately, we'd like to, as a country, from an economic security, from a national security standpoint, be able to produce the key supply chain here in the U.S. So that's where our ambition is headed, towards hundreds of gigawatt hours. But this capital, this $300 million we just closed, will help us get going on the tens of gigawatt hours, phase 2 of our expansion.
All right, Jean, really appreciate you stopping by. That is Jean Berdichevsky. He is CEO and co-founder of Sila Nanotechnologies, also one of Tesla's earliest employees. Now, coming up, we're going to switch gears and take a look at one of my favorite things. It's the ETF market, and specifically leveraged ETFs. We'll do that with Bloomberg Intelligence's Eric Balchunas next. This is The Close. Welcome back to The Close. Let's talk ETFs, because ETF life expectancy is falling fast. Data from Bloomberg Intelligence shows that the average age of a liquidated ETF is now just 2.3 years. That figure was closer to 5 years just 5 years ago. So let's unpack this trend with Eric Balchunas. He is senior ETF analyst over at Bloomberg Intelligence, also my co-host on ETF IQ. And Eric, let's just talk about what's going on. I mean, the shrinking lifespan of ETFs. Why is this happening?
Yeah, I mean, basically, there's no shame or stigma in closing an ETF. I'm old enough to remember when there was. And I remember when BlackRock closed their first ETF, everybody was like, okay, it's okay to close ETFs. This is about 10, 12 years ago. Since then, no one cares. So there's a lot of spaghetti being thrown at the wall. My colleague at Morningstar, Ben Johnson, calls it the spaghetti cannon. And there's no better term for it. And basically, people are just less patient for what sticks. A lot of these closures are some of these 2x stock ETFs. That's where a concentrated portion of that spaghetti cannon is going right now. And if you can't get liquidity in one of those pretty quickly, it's tough. So people are willing to hang on to some products for a little while, depending on the asset class and the area. But for the most part, it's basically like just trial and error. And if you can get one of these to stick, though, I mean, you are in business, like a DRAM or an SNXX. These are billion-dollar funds. They charge a decent fee, and you're good. But there's a couple eggs that got broken on the way.
Yeah, certainly. You need to break a few eggs to make an omelet. And I guess that metaphor also applies to what we're talking about. But I love this stat because it's sort of the flip side to the record launches that we keep talking about. You think about the number of new ETFs that are coming onto the market. Yes, that's true. But at the same time, you're seeing closures pick up. And as a result, as you laid out, I mean, you're seeing the lifespan of these products just shorten up as well.
You know what's interesting? Something I noticed that is really fascinating is if you look at the billion per day in inflows, it correlates pretty well to the launch per day. So back when I started this, it was like $1 billion a day in inflows, and there was about 1 launch per day. Now we're at 9 and 9. So I mean, it's just ramped up. So 9 launches a day, but they're taking in $9 billion a day. And one of the most interesting stats is the average ETF has $3 billion. And that average, that ratio, is at a high. So there's enough demand to soak up a lot of this supply. Again, there's a lot of ETFs that won't make it. But that level of demand is why you have everybody throwing the kitchen sink at this market, because the fish are biting that much.
Well, we have about a minute left with you. Is there enough demand to soak up potentially 500 ETFs coming in a year from Corgi? It's an upstart ETF issuer. And talk about a spaghetti cannon. They are just really filing like crazy.
They have really captured the imagination of all the analysts, because they've kind of done like what it took BlackRock 2 decades to do, and they're doing it in a year, which is to launch 500 ETFs. Athanasios on my team compares it to rolling up to a roulette table and putting your chips on every number, right? Of course, one will hit, do it again, another one will hit, but there's going to be a lot of dead weight there. But this is the world we're living in now, in terms of just trying to get as many lines in the water. We'll see. I mean, Corgi is just a fascinating experiment. And, you know, there will be closures. I can predict that, but they'll have a few hits.
There will be closures. Eric, really appreciate you stopping by on this Friday afternoon. That is Eric Balchunas of Bloomberg Intelligence. You can catch him and Scarlett Fu and normally me on ETF IQ Mondays at noon. It's a lot of fun. You don't want to miss it. But still ahead here on The Close, we're going to take a look at the growing role that private equity is playing in the sports world with Harbinger Sports Partners, Rashaun Williams. That conversation coming up next. This is Bloomberg. Harbinger Sports Partners, it's the private equity firm led by Mark Cuban. It's getting into the game of baseball. The investment fund announcing it's buying a minority stake in the MLB's Athletics, which will call Las Vegas its new home for the 2028 season. Bloomberg sat down with Rashaun Williams. He is founder and chief investment officer over at Harbinger Sports Partners to discuss the move.
For the first time that we just did our first deal in the Las Vegas A's. We're very excited about it. I mean, Vegas is Vegas. Everyone knows that. But the Las Vegas A's, one of the most storied franchises in all of Major League Baseball, for us to have the opportunity to partner with the ownership group there in a market like Vegas, where you can see what happened with the Raiders, you can see exactly what happened with the Golden Knights. I mean, us as owners and operators, I mean, we have a unique advantage where we understand the value creation that's getting ready to happen, moving from Oakland to Vegas. We're super excited about baseball, and the A's are our first investment.
Well, give me a sense here. When we talk about the A's and the move, I guess the official season starts for the A's in 2028 in Las Vegas, correct?
That's when the ballpark opens.
When the ballpark opens, excuse me, thank you. Obviously, relocating from Oakland here. Is the sense here that this investment is the start of a broader footprint for Harbinger in Las Vegas? Or is this simply confined to what we're seeing with the Las Vegas A's?
Yeah, we're looking at about half a dozen teams right now in North America that we're in diligence on to make investments. We really, really like Vegas. We like the demographics there. We do something called predictive analytics to do demand modeling to determine whether or not a marketplace has pricing power, whether or not you can actually make money there. What are your revenue projections if you were in Vegas versus Charlotte versus Nashville versus Salt Lake City? So we can do the analysis and determine whether or not a market is strong. Vegas is very strong. It's very premium. 30 to 40 million visitors per year coming through, and people love sports in Vegas.
Yeah, well, give me a sense here as to what the magic is in Vegas, because when we first started to see professional sports gravitate there was some concern that, well, Vegas it's a tourist town, it's transient, the type of sort of built-in fan base that you would have in a New York or Chicago, Atlanta, Green Bay isn't there. Is that false?
That's not the whole picture. Sports is migrating to the sports 2.0 thesis that we talked about when I was here a while ago, where they're not just looking at themselves as a ball team. They are looking at themselves as an entertainment company. What are you doing with that ballpark when you're not having baseball games? What are you doing with the football stadium when you're not having football games? You want to rent it out. Concerts, corporate events. What's the concert and entertainment capital of the world? It's Las Vegas. So you can make a lot of extra money renting your arena out or your ballpark, just like in Atlanta with the Battery, if you're in a market like Las Vegas. That's number one. Number two, what are those people looking to do during the daytime when they're not at the casino at nighttime? Something with some air conditioning, that's entertainment. Baseball is America's sport. It is entertainment. It's just another way for people to entertain themselves when they're in town.
Do you think that this deal and the announcement of this deal might actually help get you to that 750 and maybe beyond?
Yeah, I think people expect us to do deals like this. And I know when we are talking to investors, we're talking about our pipeline. I hope that people see this exclusive access, this storied franchise, this partnership as what's to come in the future on future storied franchises that we're able to partner with. And, we are looked upon as strategic partners to the cap table. So if our investors value that, they'll partner with us.
With regards to the structure of Harbinger, I always thought the original idea here was to do more LP to LP type of sales transactions.
Yeah, that's right.
This is a new minority stake, right? Why take that approach? Was it just what was available, or what?
Yeah, a lot of people don't know this, but there are 1,000 to 2,000 minority owners of sports teams just across the big three. It's 10 to 20 per team. You have 92 leagues. Some teams, one guy owns 90 to 99% of the stake. Some teams, a guy owns 15 to 20% of the stake. So it's case by case, but we usually buy from the minority owners who haven't had liquidity, and we come in as strategic partners. But oftentimes the control owner wants to have us on as a strategic partner as well. None of these guys need our money. We're all coming in and we're approaching them as strategic partners.
Well, on that point, though, I mean, the A's in a way kind of did need it. I mean, there was definitely a funding gap there that the Fisher ownership had talked about, and that's why they were open to bringing in other investors, PE, if you will. There's been a lot of talk that as new stadiums get built and you have new transactions and sort of the old model of relying on the municipalities to help fund that, that if more of this is going to have to be shouldered by the team and its investors, does that open up opportunities for someone like you and Harbinger? Harbinger?
Not for us. That funding gap you're referring to was closed 2 years ago.
Okay.
So they started construction on the stadium. They were fully funded on all of the commitments 2 years ago. We're just getting in today, right? So we don't usually come in to be a funding gap stop. We usually come in to be strategic partners and have alignment with owners who are fully funded, running profitable businesses. Our motto is we're not a hard money lender.
Is your focus right now going to be primarily on Major League Baseball?
Well, we're looking at all profitable North American sports. We love baseball because we think baseball teams are undervalued. We have significant expertise in baseball, and we love the structural tailwinds that we see are in place. We think we will thrive investing in baseball early on, but we also think diversifying into other leagues is part of the long-term strategy.
Well, MLB has been relatively progressive in allowing outside investments and private equity investments, more so than the other leagues. I know the NFL and others are now catching up here. Is there a disparity there that maybe limits what you can do outside of MLB?
No, they're all pretty strict. They're all very judicious on who they want as partners, rightfully so. I mean, their job is to protect the shield and the brand. And MLB was first, NBA was second, NFL was just allowed. As you know, I was personally approved by NFL as a Falcons limited partner. But they're all very strict. They have very high standards, and they want people who are great partners.
So when we talk about what's next, I am curious, and I know you're probably not going to tell me, but I'm going to ask you anyway. There are a lot of teams, there's a lot of rumors about certain teams that either might be up for sale or major portions of them might be up for sale, new stadiums being built. My beloved Chicago Bears are unfortunately going to no longer be in Chicago as they move to Indiana. Are you looking around at specific teams right now where you might see an opportunity, an opening for you to maybe make a prudent investment?
Yeah, we are. So we're in diligence with half a dozen teams right now across all of those leagues. And for us, it's about finding the right team at the right time at the right price. And sometimes it's just not the right time, right? For example, if there's a competitive auction and the price goes through the roof, we're probably not the right partners for that, right? We're private equity.
Have you been outbid on things already leading up to this?
We wouldn't even enter if we thought we would be outbid. Really? We love looking at off-market transactions where we can approach the owner and show them why bringing us on as a partner is strategic to their cap table.
My final question, this just has to do with the broad sort of lens of sports as an asset class, and something that some people would say acts as a diversifier to a lot of traditional investments as well as other alternative investments. Does it really represent that type of diversification, particularly given the longer holding periods, the somewhat narrow sort of lens of exactly where the money actually comes from, the actual revenue comes from?
Not all sports. I was just saying. So some people would throw everything in the sports category, but you have startup leagues, that's venture risk. And then you have leagues that are unprofitable, growth stage leagues. If you're looking at the profitable North American sports leagues, they are non-correlated to equities. They're growing at a higher revenue and valuation CAGR than the S&P. They're legal, local monopolies. They've been around for 100 years. I mean, these are amazing franchises. They've been around for such a long time, and they dominate sports in North America. So the profitable leagues are definitely a diversification. I think some of the earlier leagues are more of a venture play.
And our thanks again to Rashaun Williams. He is founder and chief investment officer over at Harbinger Sports Partners. Meanwhile, let's take a quick look at how markets closed out on the day on this Friday. The S&P 500 managing to push into the green, but barely so, falling for another straight week on a weekly performance basis. A lot of pain coming through when it comes to big tech. The NASDAQ 100 down by more than 1%. As you saw, a little bit of relief when it comes through in the energy markets, in the bond markets, though Brent trading at about $98 a barrel. This is The Close on Bloomberg. Private equity meets wellness. Manna Partners has backed brands including Good Culture and Gotham Greens, previously invested in names such as Vital Farms. Now Manna says that the goal is simple: help consumers live better, live longer. Joining us live, I'm pleased to say, is Ellie Rubenstein. She is co-founder and managing director of Manna Partners. And Ellie, we all know your dad, who of course is the host of Peer to Peer here over at Bloomberg, long-time Wall Street titan. Talk to us a little bit about your corner of the private equity market and how you're trying to shape it.
Thanks for having me. It's an exciting time in wellness. So Manna has been 8 years old. We've obviously backed brands that most people tend to say, I know that brand, it's in my fridge. I think the exciting part of this sector has been watching wellness be democratized. And so today, the fastest growing part of wellness is the person making $30,000 or less. Yeah, and I want to come back to that because when we started with Vital Farms, and we saw that. it is not somebody making $300,000 a year. So what we are looking for is multiple daily or weekly repeat purchases. So these are your daily, your eggs, beef, your salad, your vitamins, right? The predictable part of the economy.
Interesting. Talk to us a little bit about that more, because certainly that's a surprising stat, especially when you think about the backdrop, the economic backdrop right now. We have persistently stubborn inflation, and we're seeing food costs rise, whether you're talking about protein, eggs, or produce. And I wonder, how you put that into the due diligence that you are doing on, potential investments.
It's an amazing question. And the one thing what we've always seen is that today, a health and wellness brand, there's this view that it is more expensive. Sometimes, on average, it's actually price parity with what I would call an unhealthy legacy brand, due to how many inputs go into that brand. And so a lot of these better for you brands, what they've done is had control over their supply chain and less inputs. And that's what I think people have to understand, is that while the price is actually on parity, it's not much more than what you are paying for a legacy brand.
And you've mentioned Vital Farms. That's an investment that you've exited. Health Aid also in recent and successful exit. And I wonder how long your holding period typically is from, first investing in a company to maybe saying goodbye.
Look, we've had remarkable success. I would say when we started, I was having to explain to people what a pasture-raised egg was, what a controlled environmental agriculture meant, and why your salad would be a place that you could trust your lettuce. Today,
which is a contentious question at this point in time.
Greenhouses have been around for decades, and I think that we have always said, I went to Purdue, and we're supply chain investors that happen to have brands. And so you can underwrite to 3 to 5 years when there's tailwinds of health and wellness. But I will come back to, these tend to be brands that are category leaders in large categories. So you mentioned Health Aid. Today, it's part of Generous Brands. We still retain 10%. We have 45% of the functional beverage market. And so the functional beverage market is winning from two massive declines. One, decline in soda, two, decline in alcohol. So that's when we tend to look for what are the large economic shifts and to make sure we're the category leader or category creator.
Well, talk to us a little bit about how the wellness category has evolved, how you've seen it sort of expand here. You talk about the democratization. I mean, where have you seen sort of the demographics of the industry go?
Well, that's been the most interesting, is when we started this, I would say a lot of this would be viewed as Whole Foods paycheck, and brands also would enter to Whole Foods first. Today, brands enter Target and Walmart and Walgreens first. And a lot of that has to do, the fastest growing part of all retail today in any retailer is health and wellness. So what they are wanting is much larger quantities to get what I would say wellness for the masses. One thing I'll point out to you that's actually interesting, if you look at the data, which does show that the fastest growing part of wellness is what I would call the middle market of the U.S. So where we go wrong is we say that consumer in this K-shaped economy, we need to stop calling everybody one consumer. The health and wellness consumer is different than a luxury or a one-time expensive good. This is, again, I would say that when we call it discretionary income, this is really what I would call the preventative spend of health and wellness. It's very predictable. Your vitamins, your protein powders, your eggs, and increasingly tampons, for example, right? So, and prenatal vitamins. And so it's pretty predictable of the revenue of what we see. So the multiple weekly or daily repeat purchases is what has to come by. But last but not least, if you're making under $30,000 today, are you accessing private equity? No. This is more democratized today than the alternative sector. And so when we get, okay, this is niche, this is the Erewhon shopper, this is more accessible today for the average person to walk into the vitamin shop or walk into their Walmart than it is to go invest in a private equity sector. That's how mainstream this has become. And you have to ask why. In the time Manatree's been around, we have seen, COVID, which was a boost for our sector. I want to also come back to tariffs. Less than 0.01% of our portfolio was affected by tariffs, because health and wellness today is a predominantly U.S. economy where people are making these brands, manufacturing these brands here. Right. So this has been a boon for the American economy. And so if 68% of GDP is coming from consumer, the only growth is coming from the health and wellness spend.
Ellie, it feels like we're just getting started. Unfortunately, we're up against the clock. Really appreciate you making the time. Certainly a fascinating conversation when you think about sort of the evolution of the wellness space. That is Ellie Rubenstein. She is the co-founder and managing director of Manna Tree Partners. Now, still ahead on The Close, we're going to stick with wellness, and we're going to talk about olive oil shots actually spiking in popularity. We'll talk to the head of a company bringing her olive oil shots to Whole Foods and to Sprouts. This is The Close on Bloomberg. Time now for Next Up, where we highlight the entrepreneurs and the trendsetters moving the needle in business and the economy. First, it was the protein craze, then it was the fiber fad, and now the world's wellness obsession has celebrities, including the likes of Hailey Bieber, taking olive oil shots. Our next guest's company is bringing olive oil shots to retail for the first time via Whole Foods and Sprouts. Joining us live now is Katina Mountanos. She is founder and CEO of Kosterina. Katina, great to have you with us. And let's start with the why. Why an olive oil shot? What is that going to do for the average consumer?
Yeah, so at Kosterina, we are a wellness brand, and we are centered around this very high antioxidant extra virgin olive oil from Greece. And what we do, what's special about our olive oil, is that we harvest the olive early, which just means that we pluck it off the tree before it's ripe while it's still green. And that's in order to maximize what's called polyphenol content. Polyphenols are powerful antioxidants that essentially fight inflammation in the body, and they've been proven to reduce the risk of all chronic disease. So we subscribe to the philosophy of food as medicine, and that's what this olive oil shot is.
And so why do you think that this has taken off? I mean, I mentioned the likes of Hailey Bieber, but I mean, what does this say about the broader wellness category at the moment? How olive oil shots fit into what we're seeing when it comes to, these different crazes that I mentioned sort of catching fire?
Yeah, there really is a broad cultural shift. I think, the consumer is not new to wellness shots. They've seen ginger shots and turmeric shots. And this is an ancient ritual that truly has modern implications. And so it's not just a pantry staple anymore. People really are recognizing and becoming educated that there are true health benefits to olive oil, and it truly can be preventative medicine. And so we have seen an explosion on social media of people taking olive oil shots. When I go to Greece and work with the producers at our farms, we basically are always handed an unmarked bottle of olive oil that they say, please take this back to your family, take a shot of this every morning. And what they're handing me is the ultra early harvest extra virgin olive oil. That's the olive oil that we've taken and bottled in these glass bottle shots for convenience for the everyday consumer. And that has the highest health benefits, always over 1,000 milligrams per kilogram of polyphenol content.
And as I mentioned, I mean, you're moving into retailers such as Whole Foods, such as Sprouts for the first time. But why do I need this packaged up? Why can't I just do this myself, measure out a shot of the olive oil that I have at home?
Yeah, there are some intricacies. So the olive oil that you have at home, and even our culinary olive oils, which are naturally high in polyphenol content, they always have over 350 milligrams per kilogram of polyphenol content for our blue cooking oil, and always over 500 for our white dipping and drizzling oil. This shot always has over 1,000. And the olive oil, as you go earlier in the harvest and get that higher polyphenol content, it gets a little more bitter. This is not your typical culinary olive oil. It has a little bit of a slight burn at the back of your throat. Those are the polyphenols, and that's how you know it's working. So it's not actually the same as taking an olive oil shot that you bought at the grocery store for culinary use.
So the burn is good. If you feel the burn, that means it's working. And
yes.
Katina, I'd love to get your perspective on just what the process to get into these retailers was like. Because, as we've been talking about, there's a lot of trends that sort of spark up for a moment and then fizzle out. What was the conversation like, sort of convincing them that this is a health and wellness trend that's actually here to stay?
Yes, well, it was very different with both Whole Foods and Sprouts. Whole Foods is a very long-term partner of Kosterina. We launched there 5 years ago with just one product, and we now have 16 SKUs on shelf at Whole Foods across all our categories at Kosterina. With Sprouts, they were actually a very new retailer for us. And so what we showed them was the trend growing on social media, particularly Hailey Bieber talking about it in a Time magazine interview about how taking an olive oil shot is a non-negotiable in her morning routine. And that trend has really, made the retailers get excited about bringing products that the consumer is seeing on social media into store. It's similar to what you've seen in the beauty space. If you walk into a Sephora today, you'll see end caps of products that are popular on TikTok. I think the food retailers, the grocery stores, are looking for the same trends.
All right, Katina. Well, really interesting to hear about this and hear a little bit about your business. That is Katina Mountanos. She is the founder and CEO of Kosterina, talking to us about olive oil shots, which are just taking off. Meanwhile, let's take a look ahead to what we're watching for over the next week, because it is action-packed. On Monday, we get economic data out in the morning. Durable goods orders, the one to keep an eye on. You also have earnings coming from Applied Digital and Whirlpool. That brings us to Tuesday, when the earnings wave really begins, with the likes of UPS and PayPal reporting in the morning. After the bell, you get the likes of Ford and Visa. Also, we get U.S. wholesale inventories, consumer confidence. Wednesday, it's the big one. You have the Fed decision at 2 p.m. You also have big tech earnings after the bell: Microsoft, Meta, and Qualcomm. Thursday, jobless claims and U.S. GDP in the morning. Also more big tech earnings, with Apple and Amazon out after the bell. That brings us to Friday. You get Chevron, you get ExxonMobil, Moderna earnings out in the morning. You also get UMISH sentiment. Now, one thing you won't be watching next week is me. As you've probably noticed, I am super pregnant. I'll be out on maternity leave for the next few months, but I'll be back in early 2027. Until then, I wanted to say thank you, of course, to my co-anchor, Romaine, to my fantastic team in the control room, and of course, to you, the audience. I'll miss you. I'll see you next year. But for now, that does it for me and for The Close. Balance of Power is up next. Have a great evening. This is Bloomberg.